You're listening to Choose FI Radio. The blueprint for financial independence lives here. If you're looking to unlock the secrets to financial independence and early retirement, you're in the right place. Stay tuned and join a community of like-minded people who are getting off the hamster wheel and taking control of their lives in the pursuit of financial independence. Choose FI, your home for financial independence online.
All right, everyone, today we're going to be talking about stocks and to some degree individual stocks, but really just looking at a stock as a vehicle, a way that you could own a piece of company and really breaking that down. Within the last couple of weeks, we had Frank on talking about the role of bonds in a portfolio and giving you examples of what really comprises the bond. I think that so many of us get so used to this one button click, this easy approach to owning vast swaths of the economy, that we actually don't really appreciate what it is that we own and why it's valuable to own that. We're bringing Brian Feroldi on. Brian is a friend of Choose FI. He's a regular Motley Fool contributor, and he's a solar panel enthusiast. Let's put that in there. Anyways, Brian has done the research. Brian loves this stuff. This is his pastime. This is his hobby. This is something he thoroughly enjoys. And more importantly, he can break it down, something that is like far beyond my comprehension level, break it down to something that I can understand. I think it's going to be valuable for you and us as we plan our strategies around, instead of owning stuff, let's own assets. So to help me with this, I have my co-host Brad here with me today. How you doing, buddy?
Hey, Jonathan, I am doing quite well. Yeah, you're right. Brian is a friend of the show. He's the guy we lean on when it comes to individual stocks and the stock market generally. So I think we're going to have a real interesting conversation today about what are stocks and why do they go up, actually. And I think that's just kind of a cool take that I don't know that we've ever really talked about in depth. And I think with all the goings on in the stock market lately, it's just good to get Brian's opinion. I'm curious, after we've had Carsten on with a bunch of optimism recently, I'm interested to hear Brian's take. So Brian, with that, welcome back to Choose FI.
Hey guys, awesome to be back. Thanks for having me.
You are so welcome, buddy. Okay, well, let's hop right into it. So we had this episode a couple weeks back with Frank talking about the role of bonds in a portfolio. This is kind of like the counterpoint to that, but I think it's probably a fundamental conversation that we should have had at the beginning. We recently had someone leave us a review saying, I really love the show, and I've been deep diving into it. And even though it took like 5 or 6 episodes for you guys to explain what VTSAX was, even though you were mentioning it every 3 or 4 minutes, I finally did figure it out, and I'm loving it. So for all those people that we talk about stocks, we throw them out there, we talk about, buying the market, but we never really explore what these vehicles are. Help our audience understand at its core level, when we say you're going to buy a stock, what does that mean?
Yeah. And I really enjoyed your conversation with Frank, by the way. I learned a lot about bonds. My world is stocks. So I really want to shout out to Frank for doing a great job breaking down the bond market. I know that I learned a lot. So at its core, a stock represents partial ownership of a business. And in a very real way, when you buy a company's stock, you have a permanent claim on that company's assets and its current and future profit streams forever. And the core reason that stocks have value is because the businesses that are attached to those stocks have the ability to generate profits. And the primary reason that stocks, individual stocks, go up over the long term is because the businesses that are attached to those stocks generate profits and grow their profits over time. I know that a lot of people in the FIRE movement are huge believers in index funds. I absolutely love index funds, and I recommend them to everybody. And the reason that if you look at the index funds and that they have consistently grown over time, the driver of stock price returns at the index level and at the individual level are both the same. It's profits and profit growth. So the reasons that stocks become more valuable over time is because the companies behind those stocks increase their profit streams over time, which is not something that's talked about often because the two concepts are so disconnected from each other. If you look at the mainstream media about the finances, what do we hear about all the time? Price. What happens to the price of a stock? Have you guys ever heard anything about profits and profit growth over the last 30 years? That is the fundamental driver of why stocks are more valuable today than they were 10, 20, and 30 years ago. And that is the primary driver of why stocks will be worth more 10, 20, and 30 years from now: profits.
Brian, I definitely want to dive certainly into profits because it sounds like that's going to be the vast majority of our conversation here. But let's even take a quick step back. So if I'm buying a share today in April of 2020 of an individual stock, the company that I'm actually buying that share of, so now I'm a tiny little infinitesimal owner of that company, they get record of it. But correct me if I'm wrong, but none of that transaction, none of that price goes to that company, right? That's only the original time they sell stock. Can you explain, let's say you, the business owner, owns 100% of your company. How do these shares get out originally? How does that company make money? And then what happens in the aftermarket?
Yeah, that's a fabulous question, Brad. So let's take a look at the biggest company in the world right now, because I think that's a pretty good example. And if you own VTSAX, this is your largest holding, whether you know it or not. Microsoft. The ticker symbol there is MSFT. Microsoft is currently worth about $1.3 trillion, trillion with a T. And the question is, why? Why is this company worth $1 trillion? When this company came public in, I believe, 1985 or 1986, it was vastly smaller than it was today. But to answer your question, Brad, let's talk about the mechanics. I'm a company. I want capital. I need to raise cash in order to grow, in order to fund my business. One way that companies can do that is by taking on investors. So the way that primarily companies get money from the public markets is by going public. So they sell shares of themselves to the public on their first day of trading. That's typically called an IPO, an initial public offering. So when Microsoft went public in, again, I think it was 1986 or something like that, they sold shares of themselves to the public. So the public became a partial owner of Microsoft. And in exchange for that, Microsoft, on that very first day, got a huge cash infusion that they put to work in themselves to build products, hire engineers, buy buildings, expand their sales force, et cetera, et cetera. So that's why companies go public. They want cash from the public to fund themselves. Companies can also raise capital after their initial public offering by offering more shares of themselves to the public. That's called a secondary stock offering. But once those shares are out there and exist, and they trade hands on, say, the New York Stock Exchange or other exchanges, the company does not benefit from that directly. When I buy a share of stock from somebody, I'm not buying it from Microsoft. I'm buying it from another shareholder. However, that share that I'm buying represents partial ownership of Microsoft's profits and its assets. So I, in a very real way, am taking ownership of a tiny, tiny piece of that $1.3 trillion valuation. But you are absolutely correct. When stocks are bought and sold on, say, the New York Stock Exchange, the companies themselves do not get initial money. They have to do a secondary offering or an initial public offering to get money from the investors.
I have a question for you related to that, in that, you talked about the media and the media talking about the price of a stock. But one thing is also related to that even regular investors talk about is how expensive a stock is. And I don't think they're actually talking about the share price necessarily. When we say that a stock is expensive or that it's overvalued or some variation of that, what exactly is being described there?
Yeah, great question. Stocks are weird things. Right? Everybody here knows that if you go to Kohl's and you see a sweater that costs $50, that's an expensive sweater. If you see another sweater that costs $4, that's an inexpensive sweater. It does not work that way with stocks. So Microsoft's share price right now is $174. And if that's the only thing you knew, your natural inclination would be like, wow, that's expensive. There are stocks out there that trade for under $1. And your natural inclination there would be to say, wow, that's cheap. The real answer is that's not enough information. You do not have enough information to determine if a company is expensive or cheap based on its share price alone. There are metrics that investors use to determine value. The most common one that I'm guessing a lot of people have heard of is the price to earnings ratio, or the PE ratio. That is a measure of the price of one share of stock divided by its earnings per share. Earnings is another name for net income, which is another name for profit per share. So I'm looking at Microsoft right now. Over the last year, Microsoft has generated $44 billion in net income, $44 billion in profit. Its stock is trading at, the company is valued at $1.3 trillion. So if you divide $1.3 trillion divided by 44 billion, you get a number that is slightly over 30. So that is the real price tag for Microsoft. Microsoft is trading at slightly over 30 times earnings. Its PE ratio is 30. That is not the only metric that investors use, but that is a far better metric for judging whether a company is cheap or expensive than just looking at its share price.
I want to follow up on that because that was kind of a leading question for this next part, in that if someone is now just looking at, PE ratio, and one of the things that I feel like I hear in the background, I'm an index investor, so I largely ignore it all. But, if you're an individual investor, one thing that you hear is, wow, these PE ratios are just ridiculously high. They're way too high. Look at what we could have gotten it for back in 2009, 2011, whatever else. Surely there's a crash coming because it's so high. And I'm not going to do any investing until it comes back down to these levels, and then I'll get started again. Is that accurate? Is that all there is to it? Give us some context there.
Yeah. So the PE ratio is a very widely used common metric for judging whether or not the stock market is expensive. And to throw that number out there, it's always good to have comparisons, to have things to compare to. Microsoft's price to earnings ratio in that example was 30 or thereabouts, right around 30. What does the average company in the S&P 500 trade for? Well, right now, the average company in the S&P 500, which again is the 500 largest companies in America that are publicly traded, the average PE ratio is about 20. So Microsoft's being at 30, you could make the argument that Microsoft is more expensive. It trades at a higher valuation than the market in general. Now, the market is fairly efficient. So Microsoft is a very, very high quality company. It has numerous things going for it that protect its profits from competition, and it is growing. Microsoft, believe it or not, is still growing its profits at a very rapid rate. So because of that, when a company is growing its profits, it tends to earn a higher than average price to earnings ratio. So investors today have bid up Microsoft stock to a higher than average price to earnings ratio because they believe that the company is going to continue growing its net income at a faster than average rate. Other companies trade at very low price to earnings ratios, and some of them, even at low price to earnings ratios, can still be overvalued. That's just the nature of their business. Let me give you a quick example. General Motors, a big seller of cars, that company is currently trading at 5 times earnings, 5, whereas Microsoft is 30. If that's the only information you had, you might assume, wow, General Motors, dirt cheap. However, what's about to happen to General Motors' profits, given what we know where we are today? I would say the odds are pretty good that they're going to decline, probably pretty sharply, because General Motors sells cars, which need operational credit markets as well as people with jobs to be able to buy them. Compare that to Microsoft. What does Microsoft sell? Mostly software to big businesses. That is a far more dependable revenue and profit stream that is not typically dependent on a strong economy. So price to earnings ratios are, again, just one of many metrics that investors can use to judge value. And it's by no means perfect, but it can give you a quick glance at a company's relative value.
Brian, I love that quote you just said, judge value. That's a cool way to look at this. So just to kind of piggyback on what Jonathan said, when people hear expensive, it doesn't mean dollars per share, because there's so much additional information that you don't have there, right? You don't know the number of shares, right? Like you look at Berkshire Hathaway, their A stock, it's I think $280,000 today for one share.
Brad, is that
But
one of
then
your
you say-
bucket list goals to be able to own one share?
it actually is. I swear, I looked. It's so embarrassing. I looked at the annual report. And I'm like, can I trade my B shares in eventually when I get? So I have been looking at this, but I think there's only like, it's ridiculous. I think there's only like 800,000 A shares or some such, right around there, as opposed to some stocks have billions of shares. So, it's very important for people to hear that it's not the dollars per share. It's a lot of what's driving this is the PE ratio. And then, like you said, trends, right? Growth in earnings, potential, or in, the case of car companies, all right, you kind of read the tea leaves and see where this is going. I'm curious, are there other things that people look at? Like, talking about Berkshire Hathaway, which, as Jonathan likes to kid me, is one of my favorite companies. They famously have somewhere in the vicinity of $130 billion in cash, right? Like, how does that factor in? Because, that's a very real asset, obviously. Like, talk me through what other things stock investors look at.
So it depends on the type of company. Of a company like Berkshire Hathaway, which is an insurer, one of its core operations is insurance. The metric that is useful for judging insurers is called price to book, which is the book value of the company, or what are all the company's assets worth when taken together. So yes, to your point, Berkshire Hathaway is trading at $280,000 per share. And I could actually make a pretty compelling argument that Berkshire is undervalued right now, even though its stock price is $280,000. And conversely, you could make very compelling arguments that stocks that are trading under $1 are incredibly overvalued right now. That's a really, really hard concept for people to grasp and understand, because there's no other place in our life where the nominal price of something does not indicate value, but in the stock market, that's absolutely true. So a couple of metrics that investors pay attention to. Number one is the price to earnings ratio. Number two is the price to sales ratio, which is the valuation of the entire business divided by the company's sales over the past year. That can be a metric that applies to a lot of growth companies that do not yet have earnings. For example, a company that I like a lot is called Pinterest, and the ticker symbol there is PINS. Pinterest does not yet have consistent profits, so the price to earnings ratio on Pinterest is useless. Because of that, the metric that I use to judge Pinterest's relative value is the price to sales. Other metrics are judge things like free cash flow, or a fancy accounting term called EBITDA, which I'm sure Brad knows from his accounting days. Yes, so there are numerous metrics that you can use to judge a company's value, and it's always company specific. You can't apply the same metric to companies that are in different industries or different areas of their growth phases. You have to use the right metric on the right company.
So Brian, we've done a couple episodes recently looking at economic outlook. And, I would say in the short term, throughout the end of this year, the economic outlook is kind of dire for many sectors of the economy. Sales are going to be drastically decreased. And yet, even with that scenario right on the horizon, you see the stock market, and whether we're talking about the market, the index, or whether or not you're looking at actual companies, you see many of the stocks of those companies just going straight up, even though their business has been drastically affected by this. What's the rationale, and how does a lay investor kind of look through the noise and make a decision that's not based on just greed or fear?
Jonathan, that's a great question. In the short term, there are dozens of factors out there that affect a company's valuation and hence its stock price. It could be affected by an earnings report. It can be affected by an analyst report. It could be affected by government regulations, changes in interest rates, traders turning bearish, meaning bet against the company, traders turning bullish. It could be affected by competitor news, whether or not it beat its earnings estimates. It could be affected by economic data. It could be affected by high-frequency traders, whether or not a company gets acquired, whether or not one of its competitors does well. The list of things that affect a stock price in the short term is truly endless. And because of that, stock prices can bounce around very wildly, even when their businesses really are completely unchanged. This is why trying to predict where prices are going in the short term is irrelevant. You can't do it. It is very much akin to gambling. I am completely against anybody trying to buy or sell or try and time the market based on where they think things are going in the short term. Jonathan, to your point, name a positive economic headline that we have had in the last 3 weeks. I can't think of one. And yet what has happened to the stock market? The stock market has skyrocketed. Prior to that, the stock market plunged. Peak to trough, I think it was down 35%. It was impossible to predict those moves ahead of time. The reason that companies and markets have value in the long term is always dependent on the same factor: profits and profit growth. That's why we like to advocate owning the market for long periods of time. You guys are huge advocates of VTSAX. That's a wonderful index fund to just buy and hold, because 5 years from now, 10 years from now, 20 years from now, you can be very highly confident that all of the thousands of companies that are in VTSAX, when combined, will be far more profitable 10 and 20 years from now than they are today. And a reason, there are numerous growth drivers behind that profitability. Productivity, population growth is one, inflation, as well as the literally dozens of new markets that are opening up or are about to open up before our eyes. To give you guys a sense of some markets that I'm particularly excited about, how about artificial intelligence, machine learning, precision biology, solar panels, batteries, sensors, Internet of Things, big data, blockchain, mobile, space tourism, electronic vehicles, autonomous cars, robotics, plant-based meat, digital payments, 5G, et cetera, et cetera, et cetera. There are so many positive innovations happening in the economy right now that investors should be very confident that within the next decade plus, corporate profits will be higher than they are today.
Brian, it sounds like you've been reading a book that I gave to Jonathan about a month and a half ago. I don't know if you read it by chance. The Future is Faster Than You Think.
I can see it from here.
Yeah, by Stephen Kotler and Peter Diamandis. It's almost literally they go through every single thing you just talked about on your list of future technologies. So I'd recommend looking into it. But
I will.
Yeah, it's a wonderful, wonderful book. I don't know if Jonathan has picked it up or if it's still Jonathan sitting back there in the corner.
The cover is fantastic.
Nice. It is a beautiful cover. So, Brian, the whole thing about impossible to predict, I think that's where people, so many people are afraid of the stock market. I think that's a pretty common thing you hear, because you always hear like, oh, should I gamble on stocks? And now to your ears, you probably recoil in horror when you hear that. But a lot of people, for better or worse, think that way. And then they see something like the last 2 months where, like you said, somewhere in the vicinity of a drop of 35% and then back almost, a significant way back up. And people are looking around and saying, like, I see 5 million unemployment claims every week. We're at 15+% now. Like, future earnings, you would think, again, and I'm putting like my hat on of like just trying to use intuition, but I don't think intuition necessarily works here. Like, you would think earnings would be down, but is it just that people have said like, okay, this is a short period of time? Like, has the market, when I say people, like has the market just come to the realization this is a short period of time? Because what if it's 15 or 20% unemployment for 6 to 12 months? Like, what does the market do then? And I'm not asking you to predict the future by any means, but like, give me a sense of when the market sentiment would change, and maybe like why in this case where you see doom and gloom over and over, the drumbeat is doom and gloom economically, but yet the market doesn't seem to suggest that.
Yeah, this is why predicting prices in the short term is incredibly difficult, if not impossible. Put me in the group that thinks it's impossible. What matters on Wall Street isn't necessarily the news or the absolute results of the news. What matters on Wall Street is how the news compares to their expectations. As an example, let's say Wall Street is pricing in 20% unemployment. That's really bad. But what if unemployment peaks at 19.5%? That's better than expectations. You can make a legitimate argument that stocks should go higher because the news wasn't as bad as being priced in. Conversely, if they're pricing in 20% unemployment and it comes out to be 21%, you could make the argument that perhaps stocks would fall. So it's not necessarily the absolute value of the news. It's how news correlates to expectations at the time. And in a very real way, stock prices represent what Wall Street's sentiment or is expecting at a given period of time. To your point, trying to predict that kind of thing is unbelievably challenging. And I think that a lot of people view the stock market as a big gambling machine because they don't understand how it works. There's been such little education that's gone on about people just making the very basic connection between what a company does, how it makes profits, and how those profits impact the stock price in the long term, that I think people are generally missing that piece of information. So what do they see when they look at the market? They see prices that go up and down. They hear things like buy low, sell high, right? So people think, okay, to make money, I have to buy low and sell high. They're completely ignoring the fact that companies produce profits, and if profits grow in the long term, the company's value should go higher. You guys are huge fans of index funds because you say, to heck with any of that, I'm just going to buy the entire market and I'm going to ride the entire market higher. I think that's a fabulous strategy. I love index funds because it takes all the thinking, all the guesswork out of it. The thing to know is that the reason index funds go higher is because profits eventually go higher. In the short term, anything can happen. But I'm very confident that 10 years from now, 20 years from now, profits will be far higher than they are today. And if I'm correct, the indexes will be far higher than they are today.
So let's take all this information and apply it to a simple lemonade stand example. But before we do that, we'll be right back. You know, what's cool about this is I know that you have created presentations basically teaching your kids like kind of to appreciate the fact that owning a company is a cool idea. You know, owning an asset instead of just stuff. And I wanted to see if we could take some of that and apply it to a theoretical example. I know you've done a workup on a lemonade stand. Let's just flesh out this idea. What would kind of the concepts, the ideas that we've been talking about, what would this look like if applied to a simple business model like a lemonade stand?
I love making things as simple to understand as possible. So let's do that. Let's pretend that I owned a lemonade stand, and that lemonade stand made $1,000 in profit every single year. $1,000 in profit. 1 year, $1,000, next year, $1,000, next year, $1,000, etc. Jonathan, I come to you and I say, Jonathan, I have this lemonade stand. It makes $1,000 in profit every year, but I'm tired of running it. I want to get out. I want you to buy it from me. Okay? How much would you pay me for my lemonade stand?
Oh, okay. So here's the thing. So I know that I have 1 year of work to remake my money if I were to give you a 1-to-1 ratio. So I was like, well, I'll give you $1,000 for it. That's what I'm willing to pay.
Okay. You're willing to pay me $1,000. Let's pretend we did that. I sell you my lemonade stand, which makes $1,000 in profit. You paid me $1,000. That is a price, $1,000 purchase price, to earnings, $1,000 of earnings of 1. Well, congratulations, Jonathan. You are now earning 100% return on your investment forever. That is what you call a bargain. That would be a wonderful, wonderful deal for you and a horrible deal for me, the seller.
Ask me.
I refuse to sell you my lemonade stand for $1,000. Brad, what would you pay me for my lemonade stand?
I would offer you $10,000. I'm looking for about maybe 10% return on my money.
To be clear, as we do this example, I have to do the work to make the $1,000 profit, right?
It's self-running.
Oh, okay. All right. Okay, that does change the answer significantly.
Management, that includes everything. This is just $1,000 into Jonathan's bank account forever with you doing.
How greedy is Jonathan?
I can see why you would decline my offer.
Okay, so Brad offers me $10,000. So let's do the math on that. What is the price to earnings ratio on Brad's offer? The price is $10,000 of this purchase price. The earnings or the profits are $1,000. So Brad is offering to pay me a price to earnings ratio of 10. We all clear on that math? That's very simple, correct? Brad astutely pointed out that he would get a 10% return on his investment. He spent $10,000 to acquire this business, and he now gets $1,000 in profit in perpetuity. It would also take him exactly 10 years to get all of his money back, at which point he would have his $1,000 back plus an asset that is roughly worth $10,000. let's say that we agree to that. Brad, we both agree $10,000 is what we both agree to. It's a fair price for you. It's a fair price for me. The day before we close a deal, we hear that Jeff Bezos announces that every single Amazon Prime member in the world gets free lemonade for life.
Son of a gun.
Okay?
Uh-oh.
Do you still want to buy my business for $10,000?
I do not. I cannot imagine the future earnings will be $1,000 a year from here on out.
But I just told you it's making $1,000 per year. The business is exactly the same. Honestly, how much would you pay for the business now if that was the news that came out?
I mean, I would probably closer to Jonathan's 1,000 or
See,
maybe a little less.
I knew what Jeff Bezos was up to because he does it all. He's relentless.
He is a tough competitor. So let's pretend we both agreed, given the news, this business is now worth $1,000. What just happened? My business went from $10,000 valuation to $1,000. I just lost 90% of its value. Why? What changed? This is important. What actually changed? The business is still doing $1,000. Brad, what changed?
Well, I mean, you're right. Nothing actually tangibly changed in the running of the business, the profit margin per cup, but it's the future sentiment. I mean, the projections are that there's no conceivable way it could make the same $1,000 profit going forward.
Here's what changed. Your perception about how reliable that $1,000 in profit is. The price of my business collapsed because of your perceived stability of that future $1,000. That's it. If you want to know why do stock prices go up and down sporadically, that is the answer. Because of perceptions in the market about perceived value. Now, let's make this slightly more complicated. Instead of my business producing $1,000 in profits per year, let's attach a growth rate to it. So it grows 10% each year. Its profits grow 10%. The first year, 1,000. The second year, 1,100. The third year, 1,210. The third year, 1,331, et cetera, et cetera, et cetera. 10 years from now, my business is now generating $2,350 in profits. Follow me so far? Okay. If I hold this business, so let's remove Jeff Bezos from the equation. I could sell this business to you for $10,000. We agreed that that was a fair price. Or I can hold on to my business for another 10 years. Brad, at a PE ratio of 10, what would my business be worth in 10 years if profits grew 10%? Do you need the math again?
Oh, I don't know if I can do it. Well,
23,000?
10 years.
Something like
Yeah,
23,000?
Exactly. In 10 years, my profits are $2,350.
right.
If
so
we
it's
apply a 10 price to earnings ratio to that, my business is now worth $23,500. This is why profit growth matters. This is why profits growing affect stock market valuations in the long term. If profits grow at a steady rate over the long term, the value of the business will also grow alongside it, assuming the price to earnings ratio stays the same. If in 10 years we decide that my business is only worth 5 times earnings, it would be 5 times 2,350, which is just about $11,000. That's a very low return, given that it went from 10,000 to 11,000 over the course of 10 years. Conversely, if we decided that my business was worth 20 times earnings 10 years from now, that would be 20 times 23,000, or my business would be worth $47,000. Boy, would that be a big return. So over long periods of time, what affects stock prices are earnings and changes in the price to earnings multiple. Earnings are the biggest driver over long periods of time. Price to earnings ratios tend to normalize, but those two factors can greatly affect the price of a business.
So Brian, we're talking price earnings. So we obviously initially set this up at 10, but you're saying there are factors that could make it go anywhere essentially. Obviously, in this hypothetical, you're saying between 5 and 20 or thereabouts. What would we be looking for that would change that in a a fairly stable business in this case. So we're 10 years in, there's been this earnings growth of 10% every year. Like what would we be looking for that would change that valuation?
There's a number of things. General investor mood is one. Interest rates are a second one. So do you guys know what interest rates are right now at the federal level?
0?
0, correct. So if you want a return on your money, what are your options right now? Bonds are not very good. The yield on bonds, CDs, savings accounts, are extraordinarily low. What does that force people to do that need a cash-on-cash return? It forces a lot of them to look at the stock market. If people are forced to put more money in the stock market, what happens to the PE ratio? It expands. Conversely, if interest rates in a couple of years were, say, 6, 7, 8%, I don't think they will, but pretend that they did, what would that do? That would cause people to say, I don't want to own stocks anymore. I want to own bonds. I want the safety of bonds and a higher return. What would happen to price to earnings ratio in that scenario? It would likely collapse, because investors could get a decent return from the bonds. So there are numerous factors that affect the price to earnings ratio over time, and that's what causes huge swings in investors' willingness to pay higher prices versus lower prices. In general, in bull markets, at the very end of the bull markets, valuations are at their peak. And in general, during bear markets, valuations compress. And by valuations, we're talking about just the price to earnings ratio there. But that number is not fixed. It is generally expanding during boom times and contracting during bear times.
Hey, Brian, so I'm curious. You obviously, you asked us at the outset of this lemonade stand scenario to, like, what would you pay for this? Right. And, in my mind, my little shortcut was, I'm thinking I want about a 10% return. So I'll say it's worth 10 times earnings. But that was just made up on the fly with no information. I'm curious for you as a seasoned investor, like, are there shortcuts that you would use as even just like a starting benchmark? I know there are a myriad of factors that go into these, but is there a starting benchmark? Is there some way we can think about this? Just help me think through how I would even approach this.
Yeah, it's a tricky thing. So a very simple benchmark that you can use, that I use, is just what is the S&P 500's PE ratio? So what is the price to earnings ratio of just the average business across all 500 companies in the S&P 500? Currently, that number is 20. As you can imagine, that number bounces around quite a bit. In the early 1980s, at the very bottom before the bull market that preceded there, the price to earnings ratio got down to about 6. At the very peak before the dot-com, at the peak of the dot-com in the 2000s, the price to earnings ratio got up to about 37. So as you can imagine, you can see there could be huge variances in what the price to earnings ratio can trade at. Right now, again, it's around 20. That's a fair number, I would say, to use as a mark. But a famous economist named Robert Shiller came out with something called the CAPE ratio, which is the cyclically adjusted price to earnings ratio. And rather than using 1 year's earnings, it looks at the average of the last 10 years to kind of smooth out any temporary downturns in the economy. So that's a number that a lot of people point to kind of get a better sense of value. And for a sense, the Shiller PE ratio, which is also the CAPE, that number right now is about 26. No, none of these metrics are perfect. There's always nuance that needs to be applied when you're talking about individual companies. And it's also impossible to predict where this number is going to be when you need to take money out of the market. This is why dollar cost averaging works so well. Just continually putting money in every single month, every single week, whatever your schedule is, because you're buying whether the PE ratio is low, you're buying whether the PE ratio is high, and you are likely to get higher returns when the PE ratio is low in the future than lower returns when the PE ratio is high. But trying to figure out what is the optimal PE ratio to pay is incredibly frustrating, and there are so many factors that adjust it. The point for the listeners to know is, if you are just a regular buyer of the VTXAX, you can be confident that you're going to be getting better prices sometimes than you will at others. But over time, so long as corporate profits grow, you can be pretty darn sure that you will get a good return on your investment.
Brian, thank you so much for joining us on the show. I know, let's see, I'm trying to think if people want to connect with you and they want to follow up more, maybe they have a question, maybe they just want to check out some of your other content. What is the best way for them to connect with you?
The best way to connect with me is on Twitter. My name is at Brian Feroldi there.
You have one follower here. All right, my friends.
All right.
Hey, I only it's a very discreet, exclusive list of people that I follow. You're on it.
All right.
All right, man. Thanks for joining us on the show today.
Hey, I love this show, guys. I promote your show to everybody that I talk to in life.
Awesome, brother. Thanks so much. All right, my friends. Hope you got value. This is fun. You know, I think over the last 3 years, we've gotten a chance to really explore the basics, the fundamentals, and like you don't have to stop your education. You can always learn a little bit more. I mean, you're writing your story now. And how cool is it that you get the opportunity to learn about all these financial things that no one taught you this in school. There was no place to really teach you this information. How much is it worth when you become very familiar and comfortable with this type of content? So anyways, thanks for joining us. We'll see you next time as we continue to go down the road less traveled.
You've been listening to Choose FI Radio Podcast, where we help middle-class America build wealth, one life hack at a time.